And before we take the cash flow, I will again give a pause and ask all of you for your questions. So let me give you a small case study. We all know how to calculate the current ratio. Current ratio is current assets divided by current liabilities. This is what is current ratio. How do you calculate? Just to give you an example, if there is a company whose current assets are 200, current liabilities are 100, that means this company has a current ratio of 2. Now, today morning, we were to start at 9 o'clock. I was ready at 8:45. So I had 15 minutes time at my hand and I was free. And I was sitting on my dining table and suddenly I saw there was an annual report lying on my dining table. Since I had some free time, I just turned over the pages and I noticed that the current ratio of this company whose annual report was in my hand on 31st March 23, the current ratio was 2.5. 2.5. I again turned few pages and I noticed that on 31st March 24, the current ratio of this company came down to 1.5. And since I had some more time, I again went through and I noticed that the current ratio of this company on 31st March came down to just 1.0. Now I was little surprised, right? And I was wondering as to why is that happening? Why is the current ratio of this company is coming down from 2.5 to 1.5 to 1? I was just thinking and then I again turned over some more pages and I noticed that this company was making profit. Company was not only making profit, but was paying to everyone on time. Lenders को time पे किया, paid to suppliers on time, employees on time, to government on time, CSR expenditure also on time. So everything that the company was doing was absolutely doing on time, making profit, paying to everyone on time. But the current ratio really amazed me because it was coming down from 2.5 to 1.5 and to 1.0. So I was not really able to come to any conclusion, and then suddenly I realized it was 3 minutes to 9 and I thought I must log in. So मैंने log in किया and then I realized that I am going to meet all of you. So I will pose this problem to every one of you and will ask you as to what do you think about this company whose current ratio has gone down from 2.5 to 1.0. Is it a good sign or it is a bad sign? So I'm throwing it open to every one of you and I want you to please answer this question, and I'm again stopping to share so that we can have one-to-one interaction. So please tell me, is it a good sign or is it a bad sign?
Maybe I can give it a shot.
Yeah, please go ahead. Yes, that is what the objective is.
So my mind could be a couple of reasons. Like if I don't know what the company is, but if it had patents or something that had accrued and maybe over a period of time they've sort of leveraged that, so then the asset value comes down. It could be one, or they're looking at intangible assets and maybe looking at digitization and a digital push. So therefore your efficiencies increase, and maybe that could be one of the reasons. But I'm going to stop there.
Okay, so but the good sign or bad sign?
You can't. If you don't have more information, you can't say whether it's good or bad, because it's good if they've made these kind of investments into digital push. It's a good sign. So I don't think that's a fair marker to say whether it's good or not.
Agree. Dimple ji, absolutely agree with you. The only point that I would like to mention here for the benefit of every one of you, we are trying to understand based on this information that I have shared with you. We are already trying to understand how is the working capital management of this company. Is it a good working capital management or it is a bad working capital management? When we see that the current ratio is declining from 2.5 to 1.5 and finally ending to 1. Yes, Neelima ji.
I would would say prima facie it looks like they are collecting their receivables etc. quite fast, and they are probably paying their current liabilities just in time, not before. That would be one reason, and that shows efficient current asset management. But that's probably not everything that goes into it.
Okay. Sanjay ji?
So, sir, while your question is that whether it is good or bad, I could only say that yes, there is a point that I feel that it is a good sign, because they are managing their they are going lean and running lean and are very efficient.
Absolutely. Okay, very good. So the case that I'm discussing with you, remember, for all of us as independent director, it really becomes very crucial, very critical, because working capital is one area. Of course, it is an operating matter. So we do not have to get into the working capital management of the company on whose board we are. But by looking at the working capital management of a company, or of the company on whose board we are, we can figure it out as to how this company is doing. Now let me ask this question to every one of you, and please be vocal. As a business, what would you like? Would you like your inventories to go up, or would you like your inventories to go down? As a business.
So inventories to go down.
Right. Very good. You like your inventories to go down. As a business, what would you like? Would you like your receivables to go up, or would you like your receivables to go down?
Go up.
Go down.
Go down.
Go up or go down?
Go down.
Go down.
Everyone go down? Yes. Okay, very good. Now अब अगला क्वेश्चन थोड़ा ट्रिकी है, थोड़ा सोच के जवाब देना. As a business, what would you like? Would you like your bank balance to go up, or would you like your bank balance to go down?
Go up.
Go up. Go up. Actually, you need to deploy.
Basically, go up and keep
You need to deploy it.
investing. Keep investing.
Invest further.
किरण जी आप म्यूट हैं. किरण जी आप म्यूट हैं. निनाद जी आप भी म्यूट हैं.
The balance to go up and deploying the right decisions on investments.
Absolutely. So please remember, as a business, no business would like to have the high bank balance. The bank balance should be as low as possible. And that why? Because if you are keeping high bank balance, it is not giving you any benefit whatsoever. Your bank is earning money on your money when money is lying with you. So you would always like your bank balance also to come down as low as possible. It should not interrupt your operations, and that's all.
The answerability to the shareholders also will increase.
Absolutely. The answerability to the shareholders will always be there if your bank balance is very high. Now the fourth question, as a business, what would you like to happen? Would you like your payables to be high, or would you like your payables to be low?
High.
Would you like, all of you, would you like your payables to be high, or you would like your payables to be low? Payables mean?
So the payables can be high, but they have to be paid in time.
Yeah, they have to be paid in time, of course. So when I say your payable to be high, obviously not by delaying the payment. That, of course, is not the right approach. That is wrong. So when I say that your payable should be high, that means by negotiating longer credit periods from your business. Now, yes, please.
Then it should be higher, right?
High.
It should be high. Yes, of course, it should be high. It should be, because remember, in business, it is always good to work on somebody else's capital rather than putting your capital. And more so in the working capital. In the working capital, don't lock your capital in the working capital. Use it somebody else's capital. That is the prudent financial management. Now, please tell me, all of you have said you would like inventories to go down. All of you have said you would like receivables to also go down. All of you have said you would like payables also to be go down. Effectively what you are saying the current assets must go down on one hand. You have also said you would like your payables to go up. So now tell me, if you want your receivables to go down, you want your inventories to go down, you want your bank balance also to go down, and you want your payables to go up, if that is what you want to happen, what will happen to your current ratio? Will it go down or go up?
Go down.
Go down.
It will go down.
Go down.
And what is happening in case of this company? The current ratio is going down from 2.5 to 1.5 to 1. Good sign. Good sign. Please remember, a loss-making company by default will have a low current ratio because they have no money, so can't purchase material. Not purchasing material, not producing. Not producing, not selling. Not selling, there are no receivables. Then no money, not paying to the suppliers. So the creditors are going up. So for a loss-making company, current ratio will always be less than 1. But for a profit-making company, current ratio should be as low as possible by choice and by design. So long as company is making profit and paying everyone on time, current ratio can be as low as possible. It can be less than 1 also, which is perfectly fine. So that is what is my answer to this question, which was asked as to is the current ratio 2 a good sign or bad sign. As a finance person, I would say, I mean, of course, one will have to look into the the case to case. But as a principle, 2 current ratio is very high, and not a good sign. Okay. So with this, friends, let's come back to the final page of our.
So just a heads up of the minutes.
Okay, thank you, Tanya, once again. And I think we are quite in time. Should be able to finish. Okay.